Hey everyone, it's Paul with Investment Tuesday, and in this week's Investment Tuesday, I am going to show you a piece of news that I believe that in hindsight is going to be the most important piece of news that you wish you knew at this point in time a few years from now. All right, in my experience, like everything, where the overall stock market is, where the overall mood, emotion of the time is with respect to investment. This chart shows up at the perfect time to really make and really confirm the case that I've been laying out for some time. So I'm going to show you that. And then I am going to lay out my view of what happens for the second half of 2025, for 2026, where you want to place your bets. And then I'm also going to talk about an update, if you will, on the crypto cycle and talk about what is going on over there. Okay, before we do all of that, let us do all the things we do at this time, which is do our disclaimers and disclosures, which is that this video and the content from ATG Digital is not investment or financial advice. It is presented to you as opinion, information, engagement, or entertainment for some of you. All ATG Digital content may contain errors, oversights, mistakes. Understand that investment operations, buying, selling stock, options, crypto, they have significant risk and can lead to the loss of your principal, meaning you could lose money. Next, the owners, employees, contractors of ATG Digital, we own, we trade, we transact in the securities that are mentioned in this video and all the content from ATG Digital. We do not take money from company managements or crypto sponsors to recommend their stocks or crypto tokens. We publish an extraordinary amount of free content, research, media. There is the Substack, which goes out every market day. We've got the Ball Man Speculating podcast, and of course, YouTube that I am on right now. Social media, I am quite active on X, especially when there's a lot going on in the markets. We are reasonably active on both Instagram and Facebook. One of the things that we have introduced this year is that you can now become a member of this channel. And the way you do that is you go to this join button and you click there and then you follow through on what it says. And if you become a member of the channel, you get the Investment Tuesday video on Monday. And then you also get exclusive videos. Like after I do this Investment Tuesday, I am going to record a members only exclusive video talking about a small cap stock that has gone through a radical transformation and which is completely unrecognized by the market. And all the signs is that the market is about to recognize that the radical transformation has happened and rocket the stock higher. So that is coming for members only this week. So if you're interested in that, join the channel. Another way that you can get more of what we do at ATG Digital is subscribe to ATG Digital. You would go to atgdigital.media. Let me put that up. atgdigital.media. It's important today that you make sure that the website is exactly precise, because with AI, we can clone my picture, the website, everything can be cloned very quickly. So simply going by like, oh, well, that's Paul's face, he looks just like the guy on YouTube, not going to work. You need to make sure that it says atgdigital.media and confirm that you are on the right page. Okay. I saw this come yesterday, and I was mapping out my Investment Tuesday, and I just finished when this came, and I was like, oh, okay, I'm going to have to redo all my notes, all my planning for Investment Tuesday. All right. Without making a big fuss about it, let us get to it, because everything that I am going to say sort of is predicated on this. And I could have anticipated that this was coming, but let's not belabor the point here. Let's show this. Okay. You know Wolf Street by now. You know I use Wolf Street for charts, for information. I really recommend you read him. He comes from a skeptical point of view of many things that, let's say in legacy media goes unquestioned. And he is a great source of information on all kinds of things. And here is something that he sent out, yesterday, Saturday. Corporate profits in non-financial industries plunged by most ever in dollar terms amid massive downward revisions. I always find that a chart is more impressive than a text. So what does that look like? Yeah, it looks like that. So why bring this up? Because based on past cycles, I can tell you that every past peak cycle, you can go back to 2000 and you can kind of see there in the chart in 2007, you'll see that non-financial profits peak before, things start to go, into the tank a little bit. And what it says based on past cycles, from my experience, remember, I've been in markets for 30 plus years, is that it means that, again, my opinion, probably unpopular, probably unwelcome, is that the S&P 500 has peaked, the NASDAQ 100 has peaked. Based on past cycles, it means that corporate profits have peaked. And remember, stock prices loosely, we're not talking about the hyper speculative stocks where we're betting on companies really based on story and these kinds of things. We're talking about bigger stocks. They're based on corporate profits, right? I mean, and future corporate profits. So if corporate profits are in decline, generally that tends to act as a peaking signal for large companies. And so that's, point number one, which is that in all likelihood, it's telling you that the S&P 500, NASDAQ 100, peak. Next, it says profits have obviously peaked. And then because of that, well, it would mean that at least for companies, some number of companies, it means there's some level of financial weakness, economic weakness, which then gives support for lower short-term interest rates, which then would keep going. Okay, some pointers to bring up here based on experience. Now, many people would like to think that stock markets work like, you can literally like make linear connections between one thing and another, and you can't. The truth is that history provides a bit of a guide, but it's more that the pattern repeats rather than history repeats. So in my judgment, there are some major differences if you're looking at be like, well, oh my goodness, everything's about to crash, sell everything. Yeah, I'll say that's probably going to be a bad move. Again, my view. There's some big differences, especially comparing what is going on right now to what has happened, let's say, between 2009 and 2024, when we had a bull market very much driven purely based on low interest rates and the liquidity that it generated. We're in a different market right now, okay? And so one of the things that everyone will be thinking, well, short-term interest rates are going to go down. Everything's about to go to the moon. Yeah, except that corporate profits are going down and stock prices capitalize, corporate profit. So that's probably not going to work out. And that's why I say that, the peaking of corporate profits, is, you can go back in history, in time. It usually indicates, peaking of whatever the big indices of the time are. Today, it's the S&P 500 and the NASDAQ 100. All right, coming back to, well, what happens from here? Is there going to be, a market-wide crash? Is everything just going to go to zero? Well, not quite zero, but in 2008, it went down by 50%. If you go back to the previous sort of like, corporate profit peak, which would be, 2000 or so, there was another brutal bear market. Now, my view in this is that because of huge, massive changes that have unfolded in the US economy, the world economy, and also what is like currently going on, to change many things, my view is there's not going to be a crash. Instead, we're going to have a scenario where, yes, we can expect short-term interest rates to go down. However, long-term interest rates will not fall very much. What are long-term interest rates? What are short-term interest rates? You can see short-term yields would be short-term interest rates, 30-year yield, 10-year yield. Those are considered long-term interest rates. And we can expect short-term interest rates to keep going down. At the same time, while these interest rates, the 30 and 10-year, will likely go down a little bit, they won't go down by what they did during the period between 2009 till 2021. And the reason for that is inflation. Inflation is presently sort of like baked into the system, wired into the economy at something north of 2%. And it is because of the profligate spending of the last 25 years, the huge COVID interventions, and truthfully, the global financial interventions by the central bank. There's just too much money in the system. So inflation is going to stay above 2%. It's not going to go to 20%. 3%, 4% are not like historically very high levels. They're just significantly higher than what we have had over the last 10 or 15 years. And so that matters to bond market investors, and that is going to keep these long-term rates, at much higher levels. But then you need to think about, well, what is going on in the world today, and compared to what was going on in the world, prior to this, right? I mean, we won't know exactly when, the line was drawn, but let's just say globalization likely peaked somewhere in the last, previous 10, 15 years at some point in time. Some people say it was the global financial crisis. That was the peak. I'm not going to, belabor that point, but nonetheless, we've got a complete shift going on in the United States economy, in the global economy, where we have tariffs versus, globalization and, aspiring to complete utter free trade. We have reshoring and reindustrialization. What is that? We are bringing back manufacturing from places like China back to the United States. And that is happening not just in the United States, that is beginning to happen in Europe as well. And then, put that together, that is deglobalization, if you will, in a nutshell. So you've got a scenario where sort of like corporate profits are peaking, short-term interest rates are going to go down. Normally in this scenario, you would expect that stock prices will likely take, a pretty big tumble because, corporate profits, once they get going in the wrong direction, it's because, the economic conditions are bad. There's some major issue with the economy, with the markets, and there's going to be selling. However, because of what I said earlier, which is that we're in a moment of, let's say, historic, transition, right? All the changes going on, tariffs, reshoring, reindustrialization, they reverse what we have been doing for, I'll say, on the shorter side, 30 years, but on the longer side, maybe 50, maybe 60 years, essentially since World War II. So we've got these enormous forces that are shifting, that are going on. And so my view is this, which is that this peak in profits, these cuts in interest rates, they're going to lead to a transition rather than a crash. What do I mean by transition? Meaning that money will slowly move out of where it is today, which is, in the S&P 500, in the NASDAQ 100, or if you go into these indices, it's essentially in, I'll say 10, maybe 20 stocks. If you go look at the concentration, meaning, you look at the S&P 500 and you go, top 10 stocks, how much? Well, it's a little bit under 40%. So 10 stocks represent 40% of the S&P 500. You look at the NASDAQ 100, it's almost 70%. Top 10, 70%. So that's going to, cause underperformance in the indices. And what you'll see is underperformance rather than some, 2008 style crash. That's my view. And the underperformance will be relative to the new bull markets, right? So it then becomes really critical to be like, okay, problem, what's the solution, right? I mean, you're saying, Paul, that the S&P 500, NASDAQ 100, despite all the things that, the legacy media talks about, what I'm seeing on social media, that AI is going to cause this enormous boom, profits will boom, every company will implement AI and their profits will go up. Well, the data and evidence says that's not happening. Instead, the data and evidence says that profits have peaked, and based on past cycles, when profits peak, stock prices tend to peak. And if there is, a large segment of the market that did not get bid up because those corporate profits were mostly in, these very large companies. There are entire, I'll say like, 80, 90% of the stock market over the last 5 years has underperformed, these large companies. So there is a large swath of companies that are what? Well, they are scarce in investor portfolios. They are valuable, and they're valuable because of what is happening with interest rates. When you cut short-term interest rates and long-term interest rates stay high, you have, what's called a very positive yield curve, which is generally very positive for overall economic growth, right? For overall economic growth. And so you've got a scenario in which, you've got assets, like small cap stocks. They've underperformed like immensely over the last 5 years that are underowned. They're about to get more valuable as what the Fed does, which is cut interest rates, stimulates business for them. Remember, they have really not benefited from everything that happened, over the last 5 years, right? I mean, so, you can go look at smaller companies and they have struggled. You can go to Main Street businesses and they have struggled. So these interest rate cuts are really, setting up to benefit all the companies, both in the stock market and just in the economy, that really did not benefit from, the post-COVID boom. All right. So as a result, they're about to get more valuable. And as they get more valuable, the demand will come in. So problem is, we've got extreme concentration. We've got extreme overvaluation. Yeah, I've gotten into that in previous videos in these very large companies. All right. The question is, what do you do? All right. Everybody wants to keep their money growing. What do you do? Well, you invest in the new bull markets that are unfolding. And what are they in? Well, number one, they're in small and mid-cap stocks. Why? Well, because of the extreme concentration that we have seen over these last 5 years in the very large tech stocks and also in one particular sector, which is tech. So you've got, these areas of the market which have done extraordinarily well. And then there's, all the other markets which have been stepchildren in this bull market. Second, cyclical stocks. Remember, I was talking about that steep yield curve. A yield curve is measured by sort of like short-term interest rates and long-term interest rates. And since 30 years is, too far out, let's, take the difference between short-term yields and the 10-year bond. So when short-term rates, get cut, and we're now, at 3.8%, and the 10-year yield is at 4.1. The difference is about 0.3%. That's not very big. However, every indication is that, short-term interest rates are going to keep getting cut. And so what's over time, 0.3 is going to become 0.5, 0.5 is going to turn into 1%, then it's turned to 1.5%. And now you have the difference between short-term rates and the 10-year rate is so large that, well, companies, like banks, for example, they get to borrow at short-term rates and they get to lend at long-term rates. They're like, do you want a loan? Hey, small business, we haven't lent to you in 20 years. Come and take a loan. come on, come on, come on, take a loan. So that stimulates, what's called cyclical demand, right? Cycle relative to interest rates for actual economic growth, right? Not, money just pushing into speculative asset markets, but actually going into the economy to stimulate actual economic growth. So cyclical stocks are another place where you will see, again, a bull market unfolding. What's a cyclical stock? Financials are cyclical stocks. Energy are cyclical stocks. I know people are like, financials, energy. Nobody's even thought of investing in these for really like 10 years plus. So, that tells you, like the one side of the markets are very crowded. The other side, nobody's even thought about investing for a long time. That's where the opportunity is. Commodity stocks are in a bull market. Oil, agriculture, these stocks are all showing huge demand for the same reason, because when you have a cyclical upturn, this is a scenario where the economy is growing rather than just asset prices. And from 2009 to about 2020 or so, it was asset prices that grew. The economy really didn't grow. Now we've got the economy growing, which means you're going to need a lot of the things, to build the economy, whether it be, copper. Obviously, we need, more oil. We need more electricity. And as people can have more money, they'll, there's more food consumption. All of these things will drive a commodity cycle, and we can see it happening. You can see from the charts in the stock market this happening. Fourth is precious metals, and that is because of the inflation scenario that I described earlier. Inflation is going to be higher than what it has been for the better part of 15, 20 years. People are concerned that, our 38 trillion in debt, the fact that prices, despite the Federal Reserve lifting rates from 0 to 5+%, didn't bring prices back to 2019 levels. So people are like, yeah, I want to hedge against the US dollar. I want to hedge against fiat currencies in general. So silver and gold, yeah, big bull markets, but you guys know about that already. And the fifth one is crypto, right? Okay, so let's transition now to crypto. Because my expectation when this crypto cycle began was that it was going to parallel some of the earlier crypto cycles, particularly 2016, 2017. The truth is that the market environment for all assets has changed. We have gone from pretty much a scenario where, money kept chasing asset prices higher to where now we're in a scenario where not just in the United States, but even in Europe, people are chasing real economic growth, right? I mean, they want their economies to grow, right? So what we are seeing is that the crypto cycle now is very much aligned with short-term interest rates and the flows of money that will create, and also that pervasive fear of inflation, which some types of crypto play into. So the Federal Reserve has cut interest rates by 0.25% in September. They have essentially telegraphed to the market that they plan to cut at the next two meetings. So another 0.5% is, let's just say, guaranteed. And I believe they're going to keep cutting until they get to, I'll say on the low side, 2.5%. I'll say on the high side, 3%. So we've got another 1% or so of cuts. So if my current view is that, these short-term interest rates, you need them to happen to really get the crypto markets rolling. In other words, there's just not been enough money willing to chase crypto. As long as interest rates, were at a certain level, that now pushes the crypto cycle peak, which originally I had anticipated happening over the next month to a month and a half. It pushes it out into 2026, maybe even as much as a year later. So I'll say, somewhere between June and September of next year is now my expectation of the crypto cycle. That would be very late, But the truth is that crypto is a new asset class. The dynamics of what drive demand and supply are still sort of being formed. And increasingly, as Bitcoin supply, new supply becomes less and less meaningful post halving, it is interest rates, it is money supply that is becoming the biggest factor in it. And we're about to see the biggest shift in interest rates and money supply, over the last 2 or 3 years unfold over the next 1 year. And I believe that that is going to generate, a significant peak. There are many people talking about, how the 4-year cycle ends this year. They are going by what I used to go by, which is that they research previous cycles, and you can see that each cycle is somewhere in the range of 500 to 600 days. I don't think you can be so programmatic about it as you were in the past, because of the fact that Bitcoin new supply is almost irrelevant to the market. 95, 96% of Bitcoin is already issued. It is the amount of money that is chasing both old and new Bitcoin that is the critical factor. And the peak of that is where you will get the peak of crypto prices. So the biggest surges, will come at the end of the cycle. My view is that, we are, if a cycle, let's say, has, 5 steps, we're at step 2. We still got 3 left. And the biggest gains will come at step 5, which I'll say, between June and September of next year is where it's looking. And if you go and look, at the very end, this is when you get 50, 100% jumps in a month. So that's, where I will say we are with the crypto cycle. All right. Just wrapping all this up. We've got corporate profit speaking. Based on past market cycles, it tells you that the big indices, off the time, which today are the S&P 500, NASDAQ 100, they're peaked or peaking. It's time to, in another cycle, if there was, nothing that was cheap, undervalued, ready to be invested in, and where the market environment didn't have, all these transitions around deglobalization, tariffs, reshoring, reindustrialization of the United States and Europe, you'd go to cash in a much bigger way. However, I'll say that we're likely to see more of a what might be like a soft landing transition, and in that scenario, you want small and mid cap stocks over the large stocks. You want cyclical and commodities over tech, and you want precious metals as a hedge on inflation and the fact that people want to take their liquidity, want to take all the money that they've made over the last 5 years or 20 years and be like, hey, I don't want its purchasing power to be destroyed. And then you want to be in top tier crypto because it has, the same elements of scarcity that you see in precious metals, which is that, it's finite. It lends itself to, the idea that, hey, there's a lot of money that's about to be printed and I want to protect that money. All right. A reminder that I'm about to do my members only video on a small cap company. Remember, a small cap is where you want to be, that has radically transformed itself. And until now, it's been a company that many people have, see it as a bet on one thing, but they have made so many changes. And it's just not reflecting the stock price. And the trading recently is indicating that a bunch of people have figured this out, and they are coming to bid this higher, obviously in anticipation that other investors will come to the same point of view and bid it even higher. All right, that is Investment Tuesday for this week. Thank you for watching. This is Paul saying thank you and goodbye.